In today's FE exam video, we'll tackle a key concept from the engineering economics section of the FE exam, present worth analysis. We're given an investment with an initial cost and varying cash inflows over 6 years, and we're going to calculate its value today using an 8% interest rate. To do this, we'll apply the single payment present worth formula, which is ideal for handling non-uniform cash flows. Mastering this method is essential as it's a common topic you can expect to encounter on the FE exam. This problem was created and solved by mechatronic engineer Shante Thunderspay. Shante, take it away.
In today's question, we are presented with a series of cash flows occurring over the span of 6 years. The investment has an initial cost of $30,000 in year 0, followed by a series of positive cash flows. Here, our goal is to calculate the present worth of these cash flows at an 8% interest rate. However, since these cash flows occur at different points in time, we also need to account for the time value of money. Let's start with a basic review of the concepts behind this problem. The present worth method is a fundamental tool in engineering economics, used to evaluate the total value of a series of future cash flows as if they've occurred at the present time. This method accounts for the time value of money, which means that $1 today is more valuable than $1 in the future, since it can earn interest and grow over time. The FE Handbook provides us with a set of different formulas we can apply depending on the type of cash flow pattern we are presented with. If the cash flows are the same each year, we can use the uniform series present worth formula. On the other hand, if the cash flows increase by a fixed amount each year, we can use the uniform gradient present worth formula. When the cash flows are different each year, with no repeating pattern, we'll use the single payment present worth formula to discount each cash flow individually before adding them together to find the total present worth of the investment. Let's take a closer look at this formula to see how it may apply to our problem. Take a look at the cash flows we are presented with. Although the cash flows increase uniformly from year 1 onward, the presence of an initial $30,000 cost at year 0 would require us to account for it separately. While the uniform gradient formula could apply to the increasing portion of the cash flows, using the single payment formula on each cash flow individually would result in the simplest and most straightforward method for this problem. This is because this equation typically works in all cases, requires no pattern recognition, and simply discounts each cash flow individually with the same straightforward calculation. The single payment present worth formula is given by P over F is equal to 1 plus I to the power negative n. In this formula, P represents the present value, F is the future value, I is the interest rate per period, and n is the number of periods. The formula allows us to calculate the present value of a single future cash flow. However, when we have multiple cash flows occurring at different times, we simply apply this formula to each cash flow individually and sum the results to find the total present worth. We can directly implement this equation to solve for our investment's present worth. Let's apply this formula for each individual cash flow, from year 0 to year 6, and then we'll sum the values to find the total present value of our investment. We start with the initial cost of $30,000 at year 0, which doesn't need to be discounted since it's already at the present time. Then, for each of the future cash flows from years 1 through 6, we apply the formula one by one. For example, the cash flow of $5,500 in year 1 is divided by 1 plus 0.08 to the power 1. The $6,500 in year 2 is divided by 1 plus 0.08 to the power 2, and so on. We calculate the present value of each cash flow by substituting these values into our calculator. Once we've discounted each cash flow to its present value, we add them all together. And based on this calculation, the present worth of the investment is approximately $5,949.10. This value tells us the total worth of the investment today after accounting for the time value of money for future payments at an 8% interest rate. And that wraps up our problem. Comparing our calculated present worth to the answer choices, we see that our result is closest to option D. While our step-by-step calculations may involve some rounding or truncated values along the way, using the full values directly in your calculator should give you a result of exactly $5,949.11. To summarize, today we tackled a present worth problem involving an initial investment of $30,000 followed by a series of increasing cash flows over 6 years. After reviewing key principles and formulas from the FE Handbook, we determined that the single payment present worth formula was the most reliable method to apply, since it handles any cash flow pattern by discounting each value individually. By applying this formula to each year's cash flow and summing the results, we calculated the total present value of our investment. This process highlights how we can apply the time value of money to evaluate future cash flows in today's terms.
I hope you found this week's video helpful. In upcoming videos, we will answer more of your FE exam questions and run through more practice problems like this one. Pass the FE exam will publish videos weekly, so please be sure to click that subscribe button as you're going to get expert tips and tricks, including practice problem solutions regularly to ensure that you pass the FE exam. And please, I encourage you to ask questions in the comments that I will read and respond to in future videos. Maybe there's a specific topic you want me to cover, or a question that you need answered. Pass the FE exam will have you covered. I'll see you next week on Pass the FE exam.